Good morning, or good afternoon, or good evening, depending on when you are listening to this. We wanted to provide some color on the recent events in the markets and just do a quick recording today for release. Early on, when any of you who are clients initially met with us, one of the things we often share is if you invest with us, or really anywhere with any long-term focus, there are going to be days, weeks, months, quarters, and probably years where you see declines in your portfolio, where you lose money. And at those moments, your behavior and our behavior are going to be critically important. So that, with that as a backdrop, given that that's where we are right now, we wanted to use this call as an opportunity to give you a couple of actionable ideas. Before we do that, just a backdrop on where we are currently. Let's call it at this moment a bear market. Technical definition of a bear market is a decline of at least 20%. The S&P 500, one index that represents US large cap stocks, is at its low today almost exactly hit that, whereas other indices, let's say like the NASDAQ, are well beyond that now, and still some other indices have done a little better or not quite there. So let's call it roughly a bear market. So at this moment, again, behaviors and actions that you take and we take can have a very significant long-term impact. So without any further ado, Aaron's going to jump in first and give a couple of actionable ideas you should consider talking to us about on a one-on-one basis at this point. This whole recording is meant to be generalized commentary, not specific advice.
Thanks, Matt. We appreciate everybody tuning in. We want to get to some actionable ideas, which a lot of you have heard us speak about before, but just to reiterate what we're thinking about and the actions we're taking. Tax loss harvesting, tax loss swaps, as you might hear it called, something that's important in these times. And just to level set and explain what that is, let's just say you own an ETF that's exposed to US technology stocks, and that ETF is provided by BlackRock. Well, if you own that ETF and it happens to be down 10%, 20%, whatever it happens to be, we can sell that ETF, which goes against typically what we want to do in these times of selling, but at the same moment, buy a substantially equal investment, US tech stocks, maybe by Vanguard. So you keep your same exposure, take the tax loss, use that loss to offset potential gains that you have. So that is activity that we're working on for each of you. Each person, client, family will have a bit of a customized plan, but that is an action definitely to be taking during these times of volatility. Another thing to take action on, which we've spoken about in the past, Patrick's written about in the past, are Roth to IRA conversions. When you have money or investments in an IRA and those prices are depressed, you can take that security, convert it into a Roth IRA at these depressed prices. So let's just say you wanted to convert $10 of one particular investment. Well, now at a lower price, you're getting more shares of that same investment into your Roth, which will then grow tax-free as opposed to tax-deferred in your IRA. So in these times, again, to take advantage, not just sit and hope and wait things come back. Let's take action to better the future. The tax loss harvesting idea and Roth conversions are something that are important during these times. So those are just a couple topics that we've been speaking about recently and taking action on. And I'll pass it over to Pat for a couple other ideas that he has.
Thanks, Aaron. Excellent ideas that we're implementing, obviously, on a family by family basis right now. It all comes back to, for me at least, your financial planning and the whole reason why you're invested and what your goals are. And the three of us, along with Sam, Matt's father, have been through, tumultuous markets and looked through financial plans for people, all of which are very customized. And I find it can be a really comforting thing to revisit when we're going through down markets and volatile markets, to see from the already conservative rate of return plans that we typically create on a cash flow basis, that you're still very much on track, I think. And I can't speak across the board, of course, but using history as a guide, virtually anytime I've revisited plans for clients during a down market, we have found that, hey, we're actually still in line with everything that we're looking to accomplish. Usually that's very comforting. And I'll also mention that typically, being that we use sort of an average rate of return in many of our plans that is sub a lot of what the portfolio may generate, it's important to remember that the last 3 years or so, again, not across the board for everyone, we've had above average market returns. And so that's probably pushed you ahead of where you've needed to be from a goal perspective. And that helps put things in perspective specific to you. So the other thing I'll mention just more broadly, which filters into what Matt will talk about on a sort of rebalancing and what are we doing to potentially take advantage of market volatility, is beyond your emergency savings fund. So, hey, review the cash flow plan. I'm okay having this much cash on hand at the given moment. Whatever that number is beyond that. So if you have delta of cash beyond what you need in your emergency savings, let's add that to long-term portfolios, long-term accounts. That's oftentimes a smart strategy and goes against the sort of contrarian mentality at some point. So those are a few planning items. Matt, I'll kick it back to you to kind of expand upon the volatility and take advantage of it kind of thing.
Sure, thanks, Pat. And I should have said at the outset, I am up in the Boston area at MIT at a conference. So I tried to find a quiet spot to do this, but at a college that can often be challenging. So if you hear background noise, my apologies. But just to finish up on a couple of action items that we are going to do here on the rebalancing side, as Patrick alluded to, let's look at where we are now versus where we were, let's say, about 6 months ago. If you go back now, and again, this is only, we do a lot of research. This is just one, random metric I'm just going to mention now. Roughly speaking, on average, over time, over decades and decades, the stock market's return, you probably heard this, about 10% per year. Of course, it's almost never a straight line. You could be up 30, down 10, all over the place. But right now, if you go back to the period at the beginning of COVID, let's say the beginning of 2020, through the end of the year, you were well above average, to Patrick's point. With this sell-off right now, over the almost 2.5-year period, you're pretty darn close to those historic averages right now. So all else equal, and it's not equal, there are other factors to consider, that makes stocks a little more appealing than they were 6 months ago. Similarly, on the bond side, we had record low interest rates last year, and now they're starting to be not wildly appealing yields, but slightly more attractive yields because of all the selling in the bond market. So what are we going to do about it? We were a little bit defensive earlier this year, a little underweight stocks, really short duration in bonds, to be a little conservative there. We're likely to maintain that bond posture yet because we don't think rate increases are over, but we might look, out to 2 years instead of 2 weeks, which is where a lot of our exposure was, just to give examples. And on the stock side, where we were a little bit underweight, we are likely to take that back as we rebalance to more of a neutral weight. Again, nothing drastic, but just like anything else, I'd rather pay less for something than more for it. And this is an opportunity to take advantage of that. So with that, I'll turn it over to Pat to close us out here before it gets too loud where I am sitting.
Thanks, Matt. We appreciate that. And thank you for making yourself available while you're up at the conference in general. I'll close out a couple just behavioral factors to touch on. We have a podcast that we've teased about that's coming out specifically on this topic in the coming weeks, but 3 items clients have heard me talk about in the past, which is specific to your portfolio and what you own, are discipline, faith, and patience. And how do those work into market volatility and declining markets? Well, one, I would say you need the discipline to be able to see through some hard times, just period, end of story. That comes with the territory of long-term investing. You need to maintain faith around what you own and why you own it. Oftentimes we own a lot of really, really great companies indirectly through funds, but know that you own companies that are likely to continue to do well for many, many years into the future. So continue to maintain that faith. And lastly, keep the patience. That's part of our job, is to help you really maintain all 3 of those factors, but I think they're really important. Ask yourself those questions. maintain the patience, and we'll find ourselves in a better scenario at some point, as we have in the past. The last anecdote or metaphor that I'll mention is the blessing and the curse of public markets, in that we can see exactly how much a price of an investment is changing in real time, which is completely different from other types of assets that virtually all of you and our clients own, which is either many of you own a house or you own a private business, or both in some cases. And I use the anecdote where if someone knocked on your office or home, front door and said, hey, did you know your business or your home is actually selling for 20% less than it was yesterday or 2 weeks ago? Would your response to that to go inside and create a for sale sign and put it on the front lawn? Probably not. You'd have faith. You'd say, well, probably a bad time to sell now. I'll just go ahead and keep going about my business. So it's the same thing here. It's just the curse that within public markets, we have constant price updates and the ability to act on those things. We're going to go ahead and not do that. So that's just one more anecdote I'll mention. We appreciate everyone jumping on the call here. Matt, Aaron, thank you guys for the wisdom as always. Reach out to us with questions, and we look forward to talking to everyone soon. So thank you again.
Thank you, everybody.